Sit back, relax, and pay close attention. Because while most investors panic during wild gold price swings, traders in China's Shuibei district are quietly turning that chaos into cash. Hello everyone, my name is John, and today we're breaking down how extreme gold price volatility isn't destroying China's gold market. It's actually fueling profits at the very heart of the physical gold trade. Shuibei isn't a paper market. This is where real gold bars, jewelry, and inventory change hands every single day. And when prices move fast, money moves faster. In Shuibei, traders deal with physical gold, not ETFs or futures sitting on a screen. That means every dollar move in gold immediately changes the value of inventory. When prices spike or drop suddenly, traders don't wait, they act. The speed is one of the first ways volatility turns into profit. When markets are calm, buying and selling prices sit close together. But during volatile periods, those spreads widen. Shuibei traders profit by capturing these larger gaps repeatedly, sometimes dozens of times a day. Volatility literally increases how much can be earned per transaction. Unlike long-term investors, Shuibei traders don't care where gold will be next year. They care where it will be in the next hour. Sharp swings allow rapid buying, selling, and rebalancing. Small percentage moves, repeated again and again, quietly compound into real income. Global gold prices don't always move in perfect sync with local Chinese prices. During volatile sessions, these gaps grow. Traders exploit this by buying where gold is momentarily cheap and selling where it's temporarily expensive. Volatility creates mispricing, and mispricing creates opportunity. Many Shuibei traders hedge their physical gold using futures markets. This allows them to lock in margins while still benefiting from price movement. Instead of fearing volatility, they design their trades around it, turning uncertainty into controlled risk. U.S. political uncertainty under President Donald Trump plays a major role in keeping this environment alive. Trade tensions, tariff threats, pressure on the Federal Reserve, and unpredictable policy signals constantly shake global markets. Every headline moves the dollar, shifts interest rate expectations, and sends shockwaves through gold prices. For Shuibei traders, this constant stream of U.S.-driven uncertainty is bullish for activity. As long as volatility exists, opportunities don't disappear, they multiply. Even when gold prices fall, trading volume often rises. More volume means more deals, wider spreads, and more chances to profit. In Shuibei, markets don't need to go up to be profitable. They just need to move. So while investors debate whether gold is bullish or bearish, Shuibei traders focus on one thing only: movement. In this market, volatility isn't a threat, it's the product. Shuibei is a real-time volatility barometer. Shuibei is not just another gold market, it's a real-time barometer for global volatility. Located in Shenzhen, this district sits at the center of China's physical gold ecosystem, where refiners, wholesalers, jewelry makers, and traders deal in real metal every single day. Unlike paper markets that can absorb shocks slowly, Shuibei reacts instantly because inventory is tangible, margins are thin, and prices must adjust immediately. When global gold prices move, whether due to U.S. politics, dollar swings, or interest rate expectations, Shuibei feels it first. Traders don't have the luxury of waiting for confirmation or trend signals. They must reprice, hedge, or offload inventory in real time. That's why volatility shows up here faster and more aggressively than in futures or ETF markets. In simple terms, Shuibei doesn't predict volatility, it reveals it. And when this market starts moving fast, it's often a signal that global gold prices are about to follow. Why volatility has become the norm in gold prices? Gold price volatility today is not accidental. It is the result of several structural changes in the global financial system. Unlike past cycles, where gold moved slowly in response to inflation or long-term economic trends, modern gold prices now react instantly to macro headlines, policy shifts, and capital flows. This shift has turned volatility from an occasional event into a permanent feature of the market. One of the biggest reasons volatility has increased is the dominance of macro-driven trading. Gold is no longer traded only as a store of value or jewelry input. It is now a highly liquid macro asset. Hedge funds, algorithmic traders, and institutional investors react to interest rate expectations, dollar movements, and geopolitical risk in real time. When U.S. bond yields move, or the dollar strengthens or weakens suddenly, gold reprices immediately, often violently. Another key driver is uncertainty around monetary policy. Global markets are constantly trying to anticipate central bank actions, particularly from the U.S. Federal Reserve. Even small changes in language around inflation, rate cuts, or balance sheet policy can trigger sharp gold price moves. Because gold competes with yield-bearing assets, any shift in rate expectations directly impacts its price, increasing short-term volatility. Political risk has also become a major factor. Markets are no longer pricing policy based on stable, predictable frameworks. Instead, sudden announcements, trade disputes, sanctions, and geopolitical tensions create abrupt changes in risk sentiment. Gold responds instantly because it is one of the first assets investors turn to when uncertainty rises, and one of the first they sell when risk appetite returns. Another overlooked cause of volatility is leverage. Modern gold markets are heavily influenced by leveraged positions in futures and derivatives. When prices move quickly, stop losses are triggered, margin calls occur, and positions are forced to unwind. This creates sharp spikes and drops that are not always tied to physical supply or demand, but to positioning and liquidity conditions. Finally, global connectivity amplifies every move. Information travels instantly, markets are open nearly around the clock, and price discovery happens continuously across regions. A policy headline in the US can move gold prices in Asia within seconds. This constant feedback loop prevents prices from stabilizing and encourages rapid, repeated swings. Together, these forces have reshaped gold into a fast-moving, headline-driven asset. Volatility is no longer a sign of market stress alone. It is the natural outcome of how gold is traded in the modern financial system. And for markets like Shuibei, this constant movement is not a problem to avoid, but a condition to adapt to and profit from. Why losses didn't reduce risk appetite? They reshaped it. In most financial markets, sharp losses cause participants to step back, reduce exposure, and wait for stability to return. In Shuibei, the opposite reaction is often observed. Recent bouts of extreme gold price volatility have caused real losses for traders, yet participation has not declined. Instead, risk appetite has evolved, becoming more tactical and more focused on short-term opportunity rather than long-term certainty. The reason lies in how Shuibei traders define risk. For them, the greatest danger is not volatility itself, but stagnation. When gold prices move slowly or remain locked in narrow ranges, profit opportunities shrink. Inventory sits idle, spreads tighten, and turnover falls. Volatile markets, even painful ones, at least provide movement. And movement is essential for profitability in a high-volume physical market. After experiencing losses from sudden price reversals, traders adjusted their behavior rather than exiting the market. Position sizes became smaller, holding periods shorter and hedging more frequent. Instead of betting on direction, traders began focusing on timing, liquidity, and execution. This shift reflects a professional response to volatility, not reckless risk-taking. Another factor is the structure of the Shuibei market itself. Many participants operate on thin margins and rely on continuous cash flow. Stepping away during volatile periods is often not an option because business expenses, inventory financing, and client demand continue regardless of market conditions. Staying active allows traders to manage cash flow even when prices are unstable. There is also a psychological component. Shuibei traders are accustomed to operating in environments where uncertainty is constant. Losses are viewed as part of the trading cycle rather than a signal that the market is broken. What matters is not avoiding losses entirely, but ensuring that profitable trades outnumber losing ones over time. Volatility also creates asymmetric opportunities. Sharp drops attract buyers seeking short-term rebounds, while sudden rallies encourage quick profit-taking. Traders who understand these dynamics can extract value even when the broader trend is unclear. This reinforces participation rather than discouraging it. In effect, recent losses did not push Shuibei traders out of the market. They refined their strategies. Volatility forced adaptation, discipline, and tighter risk control. Instead of retreating, traders learned to operate more efficiently within unstable conditions. This behavior highlights a key difference between physical market professionals and speculative investors. For Shuibei traders, volatility is not an external threat. It is a condition of the business. Losses are absorbed, strategies evolve, and trading continues. Because in this market, survival depends on staying engaged, not standing aside. U.S. politics is a primary driver of gold volatility. In today's gold market, few forces create volatility as consistently and as powerfully as U.S. politics. Gold is globally priced in U.S. dollars, influenced by U.S. interest rates, and deeply tied to American financial leadership. As a result, political developments in Washington often translate directly into sharp price movements in gold, sometimes within minutes. Markets are not reacting to ideology, they are reacting to uncertainty. When U.S. political signals become unpredictable, investors struggle to price future growth, inflation, trade flows, and monetary policy. Gold, as a neutral and globally accepted store of value, becomes one of the first assets to absorb that uncertainty. This makes it extremely sensitive to political headlines, election outcomes, and policy rhetoric. Policy direction matters because it shapes expectations. Trade policy affects global growth and inflation. Fiscal policy influences debt levels and currency confidence. Regulatory pressure or support impacts financial stability. Even political pressure on institutions like the Federal Reserve can shift expectations around interest rates. Each of these elements feeds directly into gold pricing models, increasing short-term volatility. What intensifies the effect is speed. Political statements today are amplified instantly through global media, social platforms, and algorithmic trading systems. A single speech, announcement, or policy hint can trigger rapid repricing across currencies, bonds, equities, and commodities. Gold sits at the intersection of all these markets, reacting to changes in risk perception almost immediately. Another important factor is positioning. Large institutional investors often adjust gold exposure quickly when political risk rises or falls. These adjustments, combined with leveraged futures positions, can exaggerate price movements. When sentiment flips suddenly, forced buying or selling accelerates volatility beyond what physical supply and demand alone would justify. For markets like Shuibei, U.S. political volatility doesn't remain abstract. Changes in global gold prices instantly affect local pricing, inventory valuation, and hedging costs. Traders are forced to respond in real time, translating political uncertainty thousands of miles away into immediate commercial decisions. Over time, repeated political shocks condition the market to expect instability. Instead of waiting for long-term clarity, traders assume volatility will persist. This expectation itself reinforces price swings as participants trade more actively and defensively around headlines. In essence, U.S. politics has become a constant source of gold price motion rather than an occasional catalyst. The market no longer treats political uncertainty as a temporary disruption, but as an ongoing input into valuation. And as long as political outcomes remain unpredictable, gold volatility remains structurally embedded in the system, shaping behavior from Wall Street trading desks to the physical gold counters of Shuibei. President policies and why they amplify gold volatility. President's policy approach has played a central role in amplifying volatility across global markets, and gold has been one of the most sensitive beneficiaries of this environment. The key factor is not any single policy decision, but the cumulative effect of unpredictability across trade, fiscal policy, and institutional norms. Markets struggle most when future policy direction is unclear, and President's style of governance often reinforces that uncertainty. Trade policy is one of the strongest volatility drivers. Tariffs, tariff threats, and shifting trade negotiations introduce uncertainty into global supply chains and inflation expectations. When tariffs are imposed or threatened, markets immediately reprice growth prospects and costs. This creates rapid swings in the US dollar and bond yields, both of which directly impact gold prices. Even the anticipation of trade action can move gold sharply as investors hedge against potential economic disruption. Fiscal policy is another important channel. Large government spending plans, rising deficits, and debates over debt sustainability influence long-term confidence in fiat currencies. When markets expect higher borrowing or looser fiscal discipline, concerns over inflation and currency debasement increase. Gold benefits from these concerns, but the path is rarely smooth. Shifting expectations around fiscal direction cause gold prices to move sharply, as investors continuously adjust their outlook. Trump's public stance toward the Federal Reserve has also contributed to volatility. Criticism of interest rate policy, calls for easier monetary conditions, or suggestions of leadership changes can shake market confidence in central bank independence. Gold is highly sensitive to real interest rates, so any signal that monetary policy could become more politically influenced increases uncertainty and fuels rapid repricing. Another source of volatility is communication style. Markets are accustomed to structured policy guidance and gradual signaling. Sudden statements, policy reversals, or unexpected announcements disrupt that process. Algorithmic trading systems react instantly to keywords and sentiment shifts, amplifying price movements in gold and other macro assets. For Shuibei traders, these policy dynamics translate into constant price motion. Each trade headline, fiscal debate, or monetary signal from the U.S. triggers adjustments in global gold prices, which flow directly into China's physical market. Inventory must be repriced, hedges adjusted, and margins protected almost continuously. What makes Trump's policy environment particularly supportive of gold volatility is persistence. Uncertainty is not a one-off event. It becomes an ongoing condition. Markets learn to expect surprise, and gold prices remain sensitive even in the absence of immediate policy action. In this environment, gold is not simply rising or falling. It is reacting, recalibrating, and repricing in real time. Trump's policies don't just influence gold's direction, they ensure that movement itself remains a defining feature of the market. Why Trump is viewed as bullish for metals volatility. Many gold traders, particularly in physical markets like Shuibei, do not view Trump's policy environment as simply bullish or bearish for price. They see it as bullish for movement. From a trading perspective, sustained volatility is often more valuable than a steady uptrend. Trump's approach to governance tends to generate frequent market repricing events, keeping gold in a constant state of adjustment. One reason Trump is viewed as supportive of metals volatility is his impact on confidence in traditional financial assets. Trade disputes, tariff escalations, and aggressive rhetoric toward economic partners increase the perceived fragility of global growth. When confidence in equities or growth-driven assets weakens, capital flows rotate into defensive assets like gold. These rotations are rarely smooth. They occur in bursts, creating sharp price swings. Trump's stance on fiscal expansion also plays a role. Rising deficits and debt issuance increase long-term concerns about currency stability, but they also create short-term uncertainty around interest rates and inflation. Gold prices respond quickly to changes in real yield expectations, making them especially sensitive to fiscal headlines. This keeps volatility elevated even when no immediate policy changes occur. Volatility as the product, not the risk. For Shuibei traders, gold is not only a store of value, it is a vehicle for continuous price discovery. Volatility is not something to hedge away entirely, it is something to work with. Risk management focuses on controlling exposure, not eliminating movement. This mindset reflects the maturity of the physical gold market. Traders accept that uncertainty is permanent and structure their businesses accordingly. Hedging tools, rapid turnover, and disciplined execution allow them to function profitably in unstable conditions. In this sense, Shuibei represents a broader truth about modern markets. Volatility is no longer an anomaly, it is a feature of the system. And for those who understand how to navigate it, volatility is not a threat. It is the business itself. As we step back and look at the full picture, one thing becomes clear: gold's volatility is not random and it's not temporary. From the trading desks of Wall Street to the physical counters of Shuibei, gold is responding to a world defined by uncertainty, rapid information flow, and shifting political power. Volatility is no longer a phase in the cycle. It is the cycle. Shuibei shows us how professionals adapt. Traders there don't wait for perfect clarity or long-term forecasts. They accept uncertainty as a constant and build strategies around movement, liquidity, and risk control. Losses are managed, not feared. Volatility is respected, not avoided. For investors watching this, the lesson is important. Gold is not just about price direction. It is about context. Political uncertainty, especially from major powers like the United States, shifts expectations around inflation, currencies, and interest rates. Policies under leaders like Donald Trump amplify these shifts, keeping gold sensitive to headlines and macro shocks. That sensitivity is what creates both opportunity and risk. If you are a long-term investor, gold can still serve as a hedge, but expectations must be realistic. Sharp swings are part of the landscape. Position sizing, patience, and diversification matter more than trying to time every move. If you are a short-term trader, volatility can be an opportunity, but only with discipline. Without risk management, volatility destroys capital faster than it creates it. Professionals survive by controlling exposure, not by chasing price. And for everyday viewers, the biggest takeaway is this: don't confuse noise with trend, and don't mistake movement for direction. Gold can rise, fall, or move sideways, and still remain relevant in a world shaped by uncertainty. The market doesn't reward emotion, it rewards understanding. If this breakdown helped you see gold differently, not as hype, but as a living market shaped by real forces, make sure to like, subscribe, and stay with the channel. Because in volatile times, clarity is the real edge.